The much-anticipated U.S.-Iran peace talks in Pakistan have officially stalled. With the Iranian delegation leaving Islamabad and the United States canceling its diplomatic trip, the silver market reacted immediately this Monday morning, pushing back towards $76 an ounce. The global chessboard just shifted, and precious metals are directly in the crosshairs. Hello everyone, I am John Agee. Welcome back to my channel. Please do subscribe to my channel, The Wealth Reactor. Today, we are breaking down a historic weekend in the global markets. We are going to analyze the complete collapse of the U.S.-Iran diplomacy in Pakistan, dissect the exact price action of Monday's market open, and reveal the underlying macroeconomic good news that every precious metals investor needs to understand right now. This will be a comprehensive, deep dive documentary into the fundamental forces moving the silver market today. We will look at the supply chain shock, the inflation threat, and what the institutional money is doing behind the scenes. Let's dive into the data. Chapter 1. The Geopolitical Catalyst and the Strait of Hormuz. To understand the sudden, aggressive movements in silver today, we must first establish a firm understanding of the geopolitical reality. We do not look at politics for the sake of politics. We look at it to understand the flow of global capital. For weeks, global supply chains have been choking under the blockade of the Strait of Hormuz. For those who may not follow the energy sector closely, the Strait of Hormuz is the world's most critical maritime choke point. It is a narrow waterway between the Persian Gulf and the Gulf of Oman. Historically, roughly 20% of the world's total global oil consumption passes through this single, vulnerable strait every single day. When this waterway is threatened or blocked, the entire global economy feels the tremors. The financial markets, which despise uncertainty, had tentatively priced in a de-escalation last week. Institutional investors were banking heavily on peace talks mediated in Islamabad, Pakistan. The hope was that diplomatic backchannels had finally paved the way for both sides to sit down and restore the flow of global energy. But over the weekend, that diplomatic bridge completely collapsed. Reports confirmed that the Iranian delegation had flown out of Pakistan, effectively ending the dialogue before it could yield any tangible results. In response, Washington canceled its scheduled diplomatic trip, stating that the proposed terms were simply not enough to break the regional deadlock. The geopolitical translation is incredibly simple, but its impact is massive. The standoff remains. The strategic waterway is still restricted. In high finance, uncertainty breeds volatility, and volatility drives institutional liquidity straight into hard, tangible assets. Chapter 2. Monday's silver market opening and price action. This brings us to Monday morning. Financial markets operate on forward-looking expectations, and over the weekend, those expectations shifted from peaceful resolution to prolonged conflict. Following the weekend news regarding the stalled negotiations between the U.S. and Iran, the silver market experienced a massive gap up at the open on Monday, April 27, 2026. A gap up occurs when the opening price of an asset is significantly higher than the previous day's closing price, with no trading occurring in between. It is a sign of aggressive pent-up demand. Here is exactly where the key silver markets opened. Spot silver, trading under the ticker XAGUSD, opened at exactly $75.85 per troy ounce. This was a noticeable, violent jump from the previous Friday's closing price. This immediate surge reflected the instant safe haven buying as Asian markets reacted to the diplomatic breakdown over the weekend. COMEX silver futures for July contracts opened at $76.12 per troy ounce. For those new to the space, the futures market often prices in a slight premium compared to the spot market. In this case, traders were exceptionally quick to bid the futures price up in anticipation of increased geopolitical volatility throughout the entire trading week. To understand the magnitude of this opening bell, we have to look at what happened just a few days prior. This brings us to a critical point: recent weekly declines. Prior to this slight recovery on Monday, silver had been under immense pressure, dropping below the $75 an ounce threshold last week. In fact, the metal is still down roughly 15% since the broader conflict initially began. Why did it drop? Because during the initial shock of any global crisis, investors often face margin calls in the stock market. To cover their losses in equities, they are forced to liquidate their winning assets, which often includes precious metals. This creates an artificial, temporary dip in the price of silver. However, Monday's gap up represents a critical technical defense of that $75 floor. The market essentially said that $75 is the new absolute baseline, and buyers stepped in aggressively to defend it. Chapter 3: The Safe Haven Rebound. This aggressive buying leads us to our next major driver, the safe haven rebound. Silver prices have recently edged higher, successfully trading near that $76 per troy ounce level. The absolute collapse of the diplomatic talks in Pakistan has driven investors rushing back toward precious metals as a safe haven asset amidst the renewed geopolitical uncertainty. What exactly is a safe haven asset? It is an investment that is expected to retain or increase in value during times of market turbulence. Fiat currencies, like the dollar, the euro, or the yen, are backed by the faith and credit of governments. But when governments are locked in a standoff, that faith wavers. Silver, much like gold, has zero counterparty risk. It does not rely on a politician's promise, a central bank's printing press, or a peace treaty to hold intrinsic value. It has been recognized as money for over 5,000 years. When modern institutions feel existential fear regarding the global supply chain, they revert to the oldest form of financial security. They buy physical assets. And that is exactly what we saw unfold on Monday morning. Chapter 4: The Macro Forces and the Inflation Factor. But geopolitics is only half of the story. Right now, the white metal is caught in a massive macroeconomic tug-of-war, and to understand where silver is heading next, we have to talk about the inflation factor. The ongoing standoff and the continued blockade of the Strait of Hormuz have caused global energy and crude oil prices to spike violently. We are witnessing a severe disruption in the fundamental building block of the modern economy: energy. When the price of crude oil goes up, the cost of manufacturing goes up, the cost of transporting goods goes up, the cost of running agricultural machinery goes up. This creates a ripple effect across the entire globe known as cost-push inflation. Things aren't just getting more expensive because people are spending more, they are getting more expensive because they literally cost more to create and deliver. High energy prices heavily fuel inflation fears, which makes investors worry about central bank intervention. When inflation runs hot, central banks like the Federal Reserve are forced to raise interest rates or keep them higher for longer to cool the economy down. Herein lies the tug-of-war for silver. Because silver is a non-yielding asset, meaning it doesn't pay monthly interest or a quarterly dividend like a government bond does, higher interest rates typically weigh down its overall market appeal. Institutional managers will often choose a bond yielding 5% over a piece of metal yielding nothing, simply for the guaranteed return. So what we are seeing in the market right now is a historic high-stakes battle. On one side, you have the fear of geopolitical collapse and hyperinflation driving silver prices up. On the other side, you have the fear of central bank interest rate hikes trying to artificially cap the price down. Monday's surge toward $76 shows that, for now, the fear of the geopolitical fallout is overpowering the fear of interest rates. The market is waking up to the reality that central banks cannot print oil, they cannot print supply chains, and they cannot print peace. Chapter 5: The Good News for Silver Investors. This brings us to the most crucial segment of today's documentary. While the mainstream financial media focuses entirely on the political gridlock, the stalled peace talks, and the doom and gloom of the Middle East, there is a distinctly, massively bullish narrative unfolding for precious metal investors. If you are a silver stacker or someone looking to protect your wealth, here is the good news for the silver market. Number 1. The industrial supply squeeze. Most people think of silver as just a shiny monetary metal, secondary to gold. But silver is the most electrically conductive, thermally conductive, and reflective metal on the planet. It is an absolute, irreplaceable necessity for the modern industrial world. The blockades in the Middle East are heavily fracturing global logistics. Cargo ships are being rerouted, delays are piling up, and freight costs are skyrocketing. At the exact same time, the global push for green energy and advanced technology is at an all-time high. Silver is heavily utilized in solar photovoltaics, electric vehicle manufacturing, advanced military defense systems, and the microchips powering the artificial intelligence revolution. As supply chains freeze, the acquisition of physical silver by these massive industrial giants becomes increasingly difficult. They cannot simply halt production. They must acquire the metal at any cost. We are now seeing a massive divergence in the market. While the paper price of silver, the contracts traded on the COMEX, faces resistance from traders, the premium to hold actual physical metal is quietly surging. The physical supply is shrinking, and inelastic demand is inelastic. This is the perfect storm for a price breakout. Number 2. The failure of Western diplomacy and de-dollarization. The collapse of the talks in Islamabad is not just an isolated event, it is a glaring signal to emerging markets around the world. Nations within the BRICS alliance, Brazil, Russia, India, China, and South Africa, are watching closely. They are realizing that Western diplomacy can no longer guarantee the safety of open trade routes or the stability of fiat currencies. Because of this, global central banks are aggressively accelerating their de-dollarization efforts. They are buying physical gold at record, unprecedented levels to hedge against fiat instability and geopolitical sanctions. Historically, gold acts as the vanguard. It moves first, establishing a new high for precious metals. But silver, which traditionally moves with a much higher percentage volatility, eventually follows. If central banks are loading up on gold, it is mathematically primed that institutional and retail investors will eventually flood into silver, recognizing it as the deeply undervalued counterpart. Chapter 6. Forward Guidance and What to Watch Next. So, as an investor tuned into the Wealth Reactor, how do you navigate this highly volatile, news-driven environment? What should you be looking for on your charts and in the headlines as this week progresses? First, keep your eyes glued to the $76 resistance level on the COMEX futures. Monday's gap up was impressive, but the market needs to prove it can hold this level. If silver can consolidate around $76 and build a technical base of support, it paves a very clear runway for a test of the $80 mark in the coming weeks. Second, pay hyper-close attention to the crude oil markets. As I mentioned earlier, silver's trajectory right now is heavily tethered to energy. If the Strait of Hormuz remains restricted and oil pushes toward new highs, expect silver to ride that exact same inflationary wave. Oil is the thermometer for global inflation, and silver is the medicine. Third, block out the short-term, day-to-day noise. The mainstream media will constantly bombard you with panic-inducing headlines about delegations returning, political finger-pointing, and daily price dips. But as an informed investor, your job is to look at the macro fundamentals. And the fundamentals have never been clearer. Fiat currencies are under immense pressure from inflation. Global supply chains are fractured and vulnerable. Third, block out the short-term, day-to-day noise. The mainstream media will constantly bombard you with panic-inducing headlines about delegations returning, political finger-pointing, and daily price steps. But as an informed investor, your job is to look at the macro fundamentals. And the fundamentals have never been clearer. Fiat currencies are under immense pressure from inflation. Global supply chains are fractured and vulnerable. Geopolitical tensions are at a multi-decade high. and physical, tangible assets with thousands of years of historical backing are violently reclaiming their rightful place in the global financial system. Conclusion. To wrap this up, the withdrawal of the Iranian delegation from the Pakistan peace talks was merely the spark, but the structural, physical deficit in the silver market is the powder keg. Monday's violent gap up to $75.85 on the spot market and over $76 on the COMEX was not a random anomaly. It was not a glitch. It was the sound of global capital waking up to reality and running for cover. The tug-of-war between inflation fears and safe haven buying has set the stage for what could be the most incredible year for precious metals in modern history. If you found this deep dive market breakdown valuable, please hit the like button right now. It is the best way to help this video reach more investors who need to hear the truth about the global economy. And once again, I am John A.G., and I highly encourage you to subscribe to the Wealth Reactor. We don't do hype here. We do professional, data-backed insights into the global markets. Before you go, leave a comment down below. Do you think silver is going to break past $80 this month due to the supply squeeze? Or do you think the Federal Reserve will step in with interest rates to cool the market down? I want to read your thoughts. Thank you for watching. Stay objective, keep your eyes on the macro picture, and I will see you in the next market breakdown.